Thanks for joining us for Back to the Basics of the ACA. My name is Jessie Lambert, and I'm the Marketing Coordinator for WorksTime HR. I'll be your host today, and I have a few quick housekeeping announcements before I introduce our presenter, Christy Albend. First, all attendees will be receiving a copy of the recorded presentation as well as the slide deck by email on Monday, so keep an eye out for those. Second, if you have questions throughout the webinar, please submit those in the Q&A module. This should be in the bottom right of your screen, or if you have minimized your right-hand panel, you can access it by clicking the Q&A icon in the top right. I will be monitoring those questions and selecting a few for Christy to answer at the end of the webinar if time permits. Third, you'll be receiving an email shortly after the webinar with a survey link. We ask that you please take a few moments to answer those survey questions. There's only 5 of them. You can let us know how we did today and what you would like us to tackle in our upcoming webinars. So please take a few moments to complete that for us. And before we begin, we would like to share a brief legal disclaimer with you. Please note that this presentation was prepared for informational purposes only and should not be construed as legal advice or a legal opinion. You're urged to consult your legal counsel concerning your own unique situation. Now, I would like to introduce our presenter so we can go ahead and get started. Christy Albend is WorksTime HR's Director of HR and Compliance. She has 16 years of experience in the human resources field, and she has been closely following the ACA's many developments since it was signed into law. It is my pleasure to introduce her today as your presenter. Christy?
Back to the Basics was created because we recognize that while the ACA has now been around going on, this will be the 7th year since it was signed into law by President Barack Obama, there has been certainly many changes within companies and their HR departments and their HR staff. So while this really became a focus of employers around 2015 when reporting began, we recognize that not the same people are sitting in the same seats that need to have this information. So we wanted to offer a Back to the Basics webinar so that maybe if you're new to the industry and in human resources, you need to establish some knowledge base for yourself, or maybe you're a seasoned HR professional who was in a different capacity in human resources and are newer to the benefits arena, or maybe you're a seasoned benefits professional and an expert on the Affordable Care Act, but you simply want to solidify the knowledge that you've had thus far. So this is going to kind of cover some basics, very basics, and technical information of the Affordable Care Act. So with that, we will get started with our first slide here, which is just a review of what the Affordable Care Act is. It is the Patient Protection and Affordable Care Act. It was signed into law by former President Barack Obama in 2010. And its primary purposes were to curb the increased spending that the healthcare industry was facing over the prior decades, and also ensure that all Americans do have access to affordable healthcare, and that can be either through their employer, through a government program, or through a state exchange, now more commonly referred to as the marketplace. It also established subsidy programs where individuals may be eligible for premium reductions or tax credits if they qualify. So the part of the Affordable Care Act that we will be focusing on primarily today is going to be the employer and individual mandates. The employer mandate is where the Affordable Care Act dictates that applicable large employers, or ALEs, must offer affordable minimum essential coverage, providing minimum value to at least 95% of their benefit eligible employees and their dependent children in order to avoid penalties. We've got some items underlined on this slide, and these are the key components that we're going to break apart and talk about a little bit more in detail in the next few slides. And the second major component of the Affordable Care Act is the individual mandate, which states that all individuals, there are some exemptions that apply, but all individuals must have insurance coverage in order to avoid penalties on an individual basis. So with that, we will first tackle the first section of that prior statement under the employer mandate, and that is for an applicable large employer. This is who must comply with the employer mandate portion of the Affordable Care Act. An applicable large employer is identified as an employer that has at least 50 full-time or full-time equivalent employees during the prior year. And just to note, seasonal employees may be excluded from this calculation, and also employers who are members of an aggregated controlled group must combine those numbers in order to determine their ALE status. On this slide at the bottom, there is an example that comes directly from the IRS where you can use this, plug in your own numbers if you are on the cusp or unsure if you are considered an applicable large employer that should be complying with the employer mandate. You can use this example at the bottom to help determine if you would be deemed an ALE. The next item was regarding affordability. So affordability is simply addressing how much an employer is able to charge the employee for employee-only coverage. There is not an affordability stipulation for dependents or family coverage in the Affordable Care Act, but the employee-only coverage cannot exceed 9.5%, which has been indexed for inflation, of an employee's household income. And we've listed below the various affordability percentages since 2015 when the reporting and penalties began. And as you can see, there has been a slight increase year over year. However, with the upcoming 2018 year, the affordability percentage is going to be decreasing to 9.56%. This is important to note simply because employers typically are establishing their employee cost sharing premiums at the beginning of their plan years. So on a normal basis, we see premiums increasing year over year, but with the decrease in the affordability percentage, it may be possible that an employer may have to actually reduce the amount that they're charging their employees for employee-only coverage. It's my expectation that once the federal poverty level is also increased, that we may not see quite as much of a need for that. However, if you are charging premiums solely based on an employee's pay, this is where you may actually see your employer's share decrease for 2018. The next slide that we're going to talk about is regarding affordability safe harbors. The IRS has given 3 different safe harbors that employers can use that will indicate to the IRS that the coverage that they offered was affordable and met those percentage requirements. The safe harbor code will be listed on line 16 of the 1095-C for employees who were offered coverage but chose not to enroll or they waived that coverage. So the first safe harbor that we'll talk about is federal poverty level. This is stating that employee contributions cannot exceed the affordability percentage of the federal poverty level for that given year. And we have provided here the various federal poverty levels that have been determined by the Department of Health and Human Services each year, as well as the affordability percentage from the IRS. And that equates to a minimum or a maximum premium that an employer can charge in order to be able to claim the federal poverty level safe harbor. And the next affordability safe harbor that we'll talk about is rate of pay. The rate of pay states that an employee contribution cannot exceed the affordability percentage of his or her hourly wage multiplied by 130 hours per month. So for example, if an employee makes $10 an hour, if you take the $10 an hour and multiply that by 130, that equals 1,300. Then if you were to multiply that by 0.0969, that's going to result in a maximum premium of $125.97 that employee could pay in order to be considered affordable. One of the notable downsides of the rate of pay method is if you regularly have employees working overtime or greater than 130 hours in a month, you could be underestimating the amount that you could actually charge for your employee premium since their wages may be underinflated. So another option to show affordability for the coverage that you're offering is the W-2 option. This is stating that an employee contribution cannot exceed the affordability percentage of their anticipated, and that's key, box 1, W-2 wages. So for example, if in 2017 your employee is expected to make $2,500 per month after pre-tax deductions, then you cannot charge them more than $242.25 per month for employee-only coverage. Now, the notable downside for the W-2 method is the anticipated wages. So premiums are going to typically be set in advance of the coming reporting year. So when you are looking at employee wages, you're not going to be taking into consideration any increases in wages or decreases in wages that may occur and may ultimately have resulted in that number being a different number that you could be charging to your employees and still have it be determined to be affordable. So the next item that we'll talk about from the employer mandate statement is the minimum essential coverage clause. Employers must offer minimum essential coverage to be compliant with the Affordable Care Act, and there are some different components to be considered minimum essential coverage. One is guaranteed availability of coverage, so you cannot be denied coverage for any other reason than your ability to pay for that coverage. So you cannot be denied for any prior health history or anything like that. You must have coverage available to you. And then the next item is guaranteed renewability of that coverage. So similar to guaranteed availability, from year to year, you must be able to renew that coverage regardless of your health status or any changes in your health status while you're enrolled. Another component is the fair health insurance premiums, and this is what required insurers to only be able to charge a certain amount for age, tobacco, family size, and geographical location surcharges. So they could no longer just charge whatever they saw fit depending on your age. There are now limits in place to be considered minimum essential coverage. Another component is the medical loss ratio, and this is for employer coverage. If an insurance company ends up spending less than 80% or 85% if you are in a large group market of the premium on the medical care expenses compared to the premium that the employer pays, they must rebate that portion back to the employer. This does help with premium renewals, so insurers are now having to be much more conscious of forecasted claims so that they don't overestimate that number and then end up having large rebates at the end of each year. The minimum essential coverage clause also requires 10 essential health benefits that are all listed here, including emergency services, prescription drugs, maternity and newborn care, and so on, and also dollar limit rules that state the insurance companies cannot have annual or lifetime dollar limits on those 10 essential health benefits. And the next item is regarding minimum value. So in order to be fully in compliance with the Affordable Care Act, the coverage that the employer offers must meet minimum value. And that simply means that the insurance must cover on an actuarial basis at least 60% of the total costs that are incurred in the plan. And that includes deductibles, copays, and coinsurance. The employee cannot have to pay more than 40% of the costs that are incurred in order to be considered minimum value. Also, plans must have a reasonable out-of-pocket maximum. The 2017 existing out-of-pocket maximums are listed here at $6,550 for single coverage and $13,100 for family. And that does go up slightly in 2018 by $100 for single coverage and $200 for family coverage. And just to note, the minimum value stipulation is essentially stating that employer-sponsored plans must offer at least the benefits that would be offered on a bronze plan that's sold on the marketplace. So the next step, once you determine you're an ALE and you've determined the cost that you're going to provide for your insurance, and you are now on to determining benefit eligibility for your employees, what does that mean? Who does the Affordable Care Act deem to be a benefit eligible employee? This is going to be employees who work on average 30 hours per week, 130 hours per month, or 1,560 hours per year. And just to note, educational institutions that have breaks of service at least 4 weeks cannot count those breaks against the employee. So you need to either reduce the number of hours that you are expecting that employee to work to determine eligibility, or increase the amount of time that they're credited for and continue to use the denominator of 1,560 hours, whichever way you choose, you'll end up with the same results. And also, the hours worked does include paid time off, and also certain instances of unpaid time off, including FMLA, disability, jury duty, military leave, etc. And for employees that work for employers that are difficult to identify or track, such as your adjunct faculty at educational institutions or commissioned salespeople or airline employees that have layovers, employers must use a reasonable method that is consistent with the employer's shared responsibility provision. And that simply means that you do need to come up with a consistent rule and apply that to all employees that would be considered to be in that same employment category or job title or whatever it might be that you're using that hours equivalency for. The next item that we'll talk about is the breaks in service rule. This is for employees that leave your company and come back as a rehire. The ACA does have regulations surrounding rehires, and they state that employees must be gone for at least 13 weeks or more in order to be considered a break in service. Otherwise, if the break is less than that, you'll have to treat the employee as if they never left. So if they're in an ongoing measurement period, you would just continue measuring them as you would any other employee. However, if the break is for 13 or more weeks, and that's also 26 or more weeks for an educational organization, then you can treat them as a new hire and begin any measurement period or initial measurement period if it's a variable hour employee, as well as any waiting periods to offer benefits for full-time new hires. You can start them over and treat them as a new employee. There is also an optional parity rule that states if an employee has a break in service for at least 4 weeks and the break is greater than the period of employment prior to separation, this is only going to matter for employees whose breaks are less than 13 weeks. So it's really between 4 weeks and 13 weeks that an employer may apply this rule, but they must determine they're going to apply it on a consistent basis. And the example that we've given would be for an employee who is hired February 17th, 2016. They then terminate employment approximately 6 weeks later on April 2nd, 2016. If that employee is rehired on April 30th, 2016, there cannot be any break in service considered because it doesn't meet the 4-week minimum requirement. However, if they're rehired all the way to June 2nd, 2016, that would be a break in service because it does exceed the time allowed for the time that they worked, at the employer, which was just about 6 weeks. So how does an employer determine benefit eligibility? There are 2 different methods that an employer can use. You can either monthly measure your employees, and that's where you will simply state that any month that an employee works at least 130 hours, that employee is going to be considered to be benefit eligible. Or there's also what they call the look-back method. That's where an employer is afforded the option to look back across a time frame that they determine in advance and average those hours over that time frame. One of the complexities with the monthly measurement period is that you don't know an employee's hours until the end of the month. And in essence, you could find out an employee that you didn't believe was going to be full-time then ends up working 130 hours, and technically you have a requirement to offer them coverage for that prior month. So it would always be retrospective. So that does add a level of complexity to it. With the look-back method, the employer will determine a measurement period, which can be between 3 and 12 months for their ongoing employees, and they'll also determine a measurement period for their initial variable hour employees. They can use a different time frame than their ongoing employees. They just need to be consistent across their employee categories. Full-time new hires are going to be measured monthly until they complete one full standard ongoing measurement period anyway, regardless of whether an employer chooses to use monthly or look back for all of their employees. Their full-time new hires will always use that monthly measurement period. And really on an administrative level, employers are not typically going to cancel coverage for full-time employees who didn't end up working 130 hours in the month. But it does get them off the hook in the event that they didn't offer coverage to a full-time employee properly as they were supposed to. They would only be assessed penalties for those months that the employee actually worked 130 hours. Any month that an employee works less than 130 hours, they technically would not have to have an offer of coverage, but the administrative burden that would put on employers to be enrolling and then disenrolling and so on throughout the year, it's just not really practical. The standard measurement period is what all other employees outside of your new hires would fall into. This is going to be, again, a period between 3 and 12 months. Typically, the employers choose a 12-month measurement period simply because it gives you the greatest scope of data that is less variable and fluctuates less over a shorter time frame. Following the measurement period, an employer will determine an administrative period, which cannot be more than 90 days. And just to note, a new hire initial measurement period plus the admin period cannot exceed the last day of the month after the employee's one-year anniversary. And I've given an example because sometimes just looking at those words, it can be very complicated. So just for example, if you're hired in February 16th, 2015, at the end of your measurement period and admin period, it cannot exceed 3/31/2016. You'd have to have an offer of coverage if you met eligibility by no later than April 1st, 2016. The admin period is used for employers to make offers of coverage once they've determined who's eligible throughout that prior look-back period or that measurement period. And then once they make those offers of coverage, there's going to be the final period, which is called the stability period, which has to be a minimum of 6 months and cannot be shorter than the measurement period. And most employers do align their stability period with their plan year. So if you have a January 1st plan year, your stability period will begin on January 1st so that your admin period is aligning with your normally occurring open enrollment. So now that we have determined who's eligible and made their offers of coverage, the next question is, what are the employer's reporting requirements? There are 2 different requirements. One is 1095-C forms need to be sent to employees by no later than January 31st each year. Those dates were extended for the first year of reporting to March 31st and to March 2nd for last year's reporting for 2016. Forms are required for all benefits eligible employees or full-time employees in a fully or self-insured insurance plan, regardless of whether or not they have an offer of coverage. If an employee was benefits eligible, they must receive a 1095-C, even if there was no offer of coverage. Now, forms are required for all employees enrolled in coverage, regardless of eligibility status, for self-insured groups. And the reason for that is the 1095-C can accomplish 2 things. One is for the employer mandate to determine or to indicate who was offered coverage and who enrolled, what type of coverage was offered, was it fully or self-insured, and did it meet minimum essential coverage and minimum value, what months was it offered for, and if it wasn't offered, why wasn't it? Do any of the safe harbors apply? So that's going to cover the reporting for the employer mandate. Now, employees in a fully insured group are also going to receive a 1095-B form from their carrier, which is going to include all covered individuals for the individual mandate. So the employees can use that when they file their taxes to say, yes, I've had coverage for all 12 months or whatever months it might be that they're covered. They will have that 1095-B for their backup. But self-insured groups do not get a 1095-B from a carrier. So anybody who's offered coverage from a self-insured group must receive that 1095-C form, and they will use that form as their backup to prove that they were enrolled in coverage. In addition to the 1095-C forms that need to be sent to employees, you also need to file your forms 1094-C and 1095-C with the IRS by March 31st each year if filing electronically, or by February 28th each year for paper filers, but you must have less than 250 forms in order to be eligible to file on paper. And another side note, those dates were extended for the first year of reporting to June 30th or May 31st for paper filers. So we'll next look at the 1094-C form. This is the 2017, as it stands right now, this is the 2017 1094-C form. Some of the content in this presentation is for us to review today, and there is also some content that is more for your reference. It's my hope that when you get the copy of the slide deck from this presentation, you'll be able to refer back to this for any questions that you have when you're looking at your forms. So, I certainly don't need to read all of the content on some of these slides, but we do want to make it available to you. So this 1094C, we will just go through at a glance. But this tool is one of the tools that WorksTime does provide to all of our clients that kind of pulls out each of the sections of the 1094C and explains what is required for each of those sections. So this year for 2017, there are no changes to Part 1 of the 1094C. This is going to be the employer's demographic information, address, contact person, and then as you'll see, line 18 or letter E is going to be the total number of forms that are submitted with this transmittal, and then an indicator of whether or not the 1094C is the authoritative transmittal. Sometimes employers may submit multiple 1094Cs for the same tax ID. Sometimes if there's different divisions or different reporting structures, an employer may submit multiple 1094Cs, but one has to be indicated as the authoritative transmittal. The authoritative transmittal will need to have the total forms for all divisions compared to the non-authoritative transmittal forms count, which will just be what's being provided for that division. And then Part 2 is for the total number of forms that are filed on behalf of the ALE member. So this is where if you are not the authoritative transmittal, you would not need to fill out this section. But if you are the authoritative transmittal, you'll put this number on line 20. If you're only submitting one 1094C, then your numbers should match line 18 and line 20, unless you're submitting a corrected 1094C. But other than that, those two numbers would simply match. You also need to indicate to the IRS if you are a member of an aggregated group, and this can be kind of complicated. It's based on common board ownership, common board members, I should say board members or common ownership. If you are a member or determined to be an aggregated control group, you have to report aggregated data to the IRS. So if you indicate no on line 21, you would simply be able to skip Part 4. But if you are part of an aggregated control group, you'll need to list the other members of your control group in Part 4, which we'll show you in just a second. Then line 22, this is the one item that has changed for 2017. In 2016, for 2016 reporting, item B was reserved. In 2017 reporting, item C is now also reserved. That remained in 2016 for any of the non-calendar plan years that were still eligible to use that form of transition relief in the 2016 year. So for 2017, the only choices that remain are item A, qualifying offer method, and item D, 98% offer method. And there is some more description on what each of those means down below in box I, but in a nutshell, item A would simply be if you are using the 1A offer code stating that you offered affordable coverage using the qualifying offer method to a qualifying employee for all months that they were eligible in any given reporting year. You can check that box, and then you could have simplified reporting requirements. And so instead of using the formal forms that the IRS has provided, you can make your own that simply needs to contain information that the IRS has determined, like name and who was covered and when they were covered, but it doesn't have to be on a formal 1095 form to your employees. So that's the benefit of electing to opt into item A on transition relief options. And then on D, if you choose the 98% offer method, if you qualify for that, you're certifying that you have offered affordable minimum value health care to at least 98% of your employees, and that you filed a 1095C form for those employees. So rather than the minimum essential coverage requirement of 95%, you're stating you've offered to 98% of your eligible employees, and therefore you won't have to report on the next section the number of full-time employees that you had. It's just another simplified reporting item. Okay, now the next section of the 1094C is going to be Part 3, where you'll indicate that you offered coverage. You'll indicate either yes or no that you offered coverage and that it meant you met the 95% requirement requirement of the employer mandate. So if you met the requirement for all 12 months, you would just need to check that box on line 23. But if you met it for some months and not others, then you would check those boxes on an individual basis. And then on column B, this is where you will report, you do not need to report if you chose item D on the section up above if you used the 98% offer method. But if you did not, this is where you'll report the total number of employees that you determined to be full-time benefit eligible for each existing month. If you happen to have the exact same number of full-time employees for every month of the reporting year, you can also put that on line 23. But for the majority of employers that have any kind of turnover, those are typically listed on a monthly basis. Then you would put in column C your total employee count. This includes benefit eligible and not benefit eligible employees. And then column N is if you indicated that you were part of a controlled group in the prior part 2 of the 1094C, you would check the boxes for the appropriate months that you were determined to be part of a controlled group. The last change on the 1094C for the 2017 filing year is column E. We've got the little pop-out using letter O. This is no longer going to be used in 2017 since you cannot use the transition relief, so you don't need to put a code in column E for this year, so this is reserved, grayed out, cannot be used. And the last section of the 1094C is part 4. This is only going to need to be used by employers who are part of an aggregated control group. You would list all of the additional members in your control group. There's room for, I believe it's 30 additional employers. Those are listed in order of company size. And if you do have more than the amount that's available, you do not have to add additional pages. You only need to report the top 30 for that. And the next form that we talked about that is a requirement of the Affordable Care Act is the 1095-C form that must be sent to employees and filed with the IRS each year. We have the same nice tool here for you to use that you can reference later if you're curious to what each section is for the 1095-C form. But just at a glance, there are no changes to the 1095-C form for 2017 reporting. Part 1 is going to be your employee's information and your employer information, including the employer's tax ID. Part 2 is going to indicate the offer of coverage or lack of an offer of coverage. And if there was a lack of an offer of coverage, line 16 will be where the employers will use their safe harbor codes that would indicate to the IRS that while there was not an offer of coverage, there was not a requirement to be one, and therefore no penalty should apply. So whenever it's possible to use a safe harbor code on line 16, it is recommended that one should be used. And then in part 3 is where self-insured groups would list all of the covered individuals that are enrolled in the self-insured plan, including their social security number. You can use date of birth if the social security number is not available, but you do need to meet IRS requirements on attempt at obtaining that social security number. You can't simply just state, well, I didn't really try and I'm not going to bother, so I'll use a date of birth. You do need to have at least 3 different attempts to show the IRS you tried to get a social security number. And then you would indicate for each month that an individual was covered in the check boxes on section E of part 3. Now the next 2 slides, these are definitely going to be tools for you to take with you. We won't go through these in detail together today, but we have a listing of the 1095-C codes that you would use for indicating an offer or lack of an offer on line 14. And then we also have the line 16 safe harbor codes that you may choose to use, if any apply, for your employees' 1095-C forms. Again, this is just for your reference. You can use this to go back and see to ensure that you are using the right codes on your form. So the next section that we're going to talk about is regarding penalties. There are 2 possible penalties under the employer shared responsibility provision. There's the IRC section 4980HA penalty and the 4980HB penalty. And just to note, neither penalty will apply to an employer unless at least one full-time benefit eligible employee ends up purchasing insurance through the marketplace and is eligible for a subsidy or a cost-sharing reduction. So the employer mandate states that if an employer fails to offer coverage to essentially all And by definition, that is 95% currently. It was 70% in 2015, but it's now currently at 95%. An employer must offer coverage to at least 95% of their benefit eligible employees, or it may trigger one of those penalty notices when an employee goes to the exchange and receives coverage. The A penalty is considered the big penalty. This is the penalty that will apply to your entire benefit eligible population, even if only one person goes to the exchange and receives a subsidy. And those amounts for each different year since the reporting has begun are listed below. Again, those have gone up each year, a little bit each year. So for the 2017 reporting year, if an employer does not meet the 95% mark and one of their employees goes to the exchange and receives a subsidy, an employer could pay $2,260 times the number of full-time employees in their company minus a 30 employee reduction, and that was an 80 employee reduction in 2015. So that's considered the big penalty. The other penalty that an employer may face is the 4980HB penalty. And this penalty cannot be greater than the A penalty, and an employer can only be assessed one penalty or the other. They won't be assessed both. But the 4980HB penalty is potentially the smaller penalty that states an employer offered coverage that was not affordable or met minimum value. It does have the same trigger. A benefits eligible employee receives coverage from the marketplace, but they were offered coverage from their employer that wasn't affordable or meeting minimum value. And this amount is a little bit higher per person, but it is only assessed on a per person basis rather than the entire employer population. And those amounts are indicated here on this slide. And again, those amounts have gone up a little bit over the course of the last couple of years, and it will be going up again for 2018 reporting. And then the next penalties are the IRC, or Internal Revenue Code 6721 and 6722 penalties. These are the penalties that I think do sometimes get complicated and mixed up with the A and B penalties because they do still apply, but employers are more right now focused on the A and B penalties because the 6721 and 6722 penalties haven't been as prevalent, especially with the good faith reporting efforts that the IRS allowed for the first couple of years of reporting. But these penalties can be significant, so it's important to pay attention to those. The IRS can impose a penalty of this in 2017, this year, $260 per return that is not correctly furnished to an employee or correctly filed to the IRS. And this penalty can be doubled if it's just intentional, if it's determined to be intentional disregard. So if an employer is still kind of sitting back and saying, I still think this Affordable Care Act stuff is going to go away, this employer mandate is going to go away, I'm not going to bother to report, those can get really costly because not only do the fines double or more than double in 2017, 2018, but there is no limit to the amount that can be assessed for that employer. So if you are a larger employer that has a lot of 1095-C forms that should be sent, that can be extremely expensive. Now, if the forms are filed but incorrectly, the IRS still can penalize the employer per return of $260 per return, and there is a maximum if it is not considered intentional disregard. The maximum amount that the IRS will impose is based on the employer's gross receipts, if they're greater than $5 million or if they're $5 million or less, and that is for the prior 3 years of business being in operation. So assuming that we've made it through all of the first phases, we have determined how we're going to track our employees, what coverage we're going to offer, and we're going to report to the IRS. Now is the time where the IRS is sending out their penalty notices for employers who may have missed the mark in 2015. The IRS is sending out what's called the 226J letter. This is an official notice that a full-time employee has received a premium tax credit and that a payment may be owed. It does indicate on a monthly basis the payments that are owed. And if this is going to be an A penalty, for instance, it'll indicate for any months that an employer failed to meet the minimum essential coverage requirements of 95%. Or if it's a B penalty, this would be indicated on that letter 226J. And just to note, this is not a bill or a demand for payment. It's an opportunity for an employer to respond to the IRS to let them know if they agree with the assessment or if they would like to appeal or provide additional information that may change the IRS's position. So just a sample of the penalty notice 226J. This is the notice that the IRS did finally begin to send at the beginning of November. There's a couple of key pieces of information on the first page that you'll see. The first one that we've highlighted is the response date. The IRS is giving a 30-day time frame to respond, and there is no wiggle room on that. You can request an extension, but you still need to file a formal request for that to happen. And then the proposed employer shared responsibility provision tax assessment. This is going to be the big number that is going to be a calculation of your total indicated full-time employees, if it's the A penalty, or how many employees received coverage that was not minimum value, if it's a B penalty. So what do you do when you get this notice? So you must submit a form 14764. This is the formal IRS response that all employers must send in, even if you are in disagreement or in agreement. That is the form that you're going to use to reply. If you are in agreement, you'll submit the form and you can include a payment, or you can wait for your actual notice and demand for payment. If you're not in agreement, then you'll submit that form. You'll need to include a signed statement that explains why you disagree, and then you'll also need to make any changes to the Employee Premium Tax Credit Listing Form 14765. And then you'll want to add any supporting documentation if it's necessary. And it's very clear the IRS does not want companies refiling to the IRS through the electronic system. They want this handled through the penalty notification process. So if you do need to change information on your 1095Cs or your 1094C, it is advised that you would put this all together in your response to the IRS with your 14764 form. Here's an example of the 14764 form. This is going to be where the employer will fill out their information at the top. And then in the middle, if you agree, you'll check the box, sign and date it. Or if you disagree, you'll check the box more towards the bottom of the form. If you're submitting your payment, if you are currently set up to use electronic payments, you can use those to pay your penalties. Or even if you're disagreeing, you still need to check a box at the bottom of this form. You'll check the box that says no payment. And last, I'll just point out that you can authorize a third party to handle your employer shared responsibility matter. If you want to authorize a third party person or company, you would need to fill out that second page of 14764. And then the next form is 14765. This is the Employee Premium Tax Credit Listing, where it looks a little similar to an employee's 1095C form where your codes are going to be listed. You'll see the employee name, the last four of their social, and then if they had the same codes for all 12 months, they'll be in that first column. But if their codes change throughout the year, you'll have the proper codes for each month. Now, if a month is not highlighted, that's the month that an employee received the premium tax credit. So it's the not highlighted months that the employer needs to be concerned about. Did you provide the right codes on your 1095C forms? Did you actually make an offer of coverage but didn't indicate that on their codes? Or were they not even a full-time employee, but you've indicated them as such on their forms? So there's some different things that you'll need to look at. You'll need to start with your data. That is going to be the first step in determining what the issues are and how to respond on this 14765 form. And then if you do attach additional information, if you want to provide, proof of an offer of coverage or whatever it might be, you'll check that box on the right-hand side of the form to be sure that the IRS knows to look for that for each of the individuals that are listed on this listing. So then what happens, now that you've sent the 14764 and 5 forms back to the IRS will then respond to the employer with their letter 227. That's going to contain any further actions that are required by the employer. And if the employer disagrees with letter 227, they can still request a pre-assessment conference with the IRS Office of Appeals. That will typically occur 30 days from the date of the 227 letter. And failure to reply to the initial letter 226J will result in an IRS demand for payment and notice CP220J. That is going to be, once that date expires on the first page of your letter, that's what is going to happen next. You will receive that demand for payment and that notice. Okay, so we've talked a lot today. We are running out of time, so I just want to touch on a couple of things. We've covered an overview of the Affordable Care Act, the important components of the employer shared responsibility provisions, including who must comply with all of this, what are you required to do in order to comply, including tracking benefit eligibility, offering coverage that meets the minimum requirements, reporting to the IRS, and then responding to any penalty notifications that you might receive. And if all of that seems like a lot of responsibility for a single HR person or department to manage, there are ways to ease those burdens and get support. Given the various complexities of navigating the Affordable Care Act compliance requirements, as well as the significant fines that can go along with lacking compliance, many employers have decided to outsource this function to companies that specialize in this subject. And WorksTime is certainly proud to be considered one of the best options when it comes to outsourcing your ACA compliance needs. We do offer 2 different levels of technology and service to best meet the needs of the employers that are looking to outsource this requirement. We have a reporting-only option where you would need to provide your basic employee data based on who you've determined to be benefit eligible for the reporting year. And then we would calculate the proper codes and ensure that those forms that go to the IRS are correct. We'll file those to the IRS with our own unique TCC on your behalf. This does have a one-time annual fee. And then we also offer a tracking and reporting option. This is our full service solution where you'll provide us, in addition to your employees' basic demographic information, you'll also provide WorksTime with your hours and pay data, so we can track who needs to have an offer of coverage, and we can send alerts to you in real time to know that you need to make those offers of coverage. In addition to all of that, we certainly would handle the same codes calculations and forms filing to the IRS on your behalf. And we do also offer fulfillment services for both options if you do elect to have WorksTime handle that for you. The tracking and reporting full service solution is a per employee per month fee. And if you are interested in more information on either one of those solutions, you can contact WorksTime at info@workstimehr.com. And that concludes my presentation.
Thank you, Christy. It looks like we have a little bit of time to go through a few questions if you're ready.
I'm ready.
Okay, great. The first one is, what do we need to have to prove to the IRS that we don't deserve a penalty? You mentioned supporting documentation. What might that be?
It's going to depend on the circumstances that the penalty is addressing. So one of the things that we would find most necessary is the IRS is getting their information from your 1094-C form. If you have indicated on your 1094-C form that you did not offer coverage to 95% of your employees, but you know that you did, I think the first step would be to correct your 1094-C form to indicate a yes in that section. That may be reworking your data, that may be recalculating your numbers of benefit eligible employees compared to full total headcount, and ensuring that you did meet the 95%. And when you did, that 1094-C would indicate that. In addition, if that's going to change the codes that you've reported to the IRS, maybe you just didn't report that you made an offer of coverage, so you've got an employee that doesn't have a coverage record, so it shows on their 1095-C a no offer, but there was no excuse. Well, to me, the supporting documentation that you might provide would be a corrected 1095-C form. Again, the IRS has been very clear, don't refile these with the IRS, but it's our belief that that's because they don't want two different divisions managing this process. They want to filter it all through one place. So that doesn't mean that you don't want to correct your data. However, that said, there certainly is some exposure if you do correct your 1095-C forms and 1094-C form. Could the IRS then start looking at the 6721 and 6722 penalties for failure to report correctly? I think they could, but I don't think that that's the intentions, especially given the good faith effort relief that employers have been provided. I don't think that the employers that are receiving these penalty notices have been, intentionally disregarding the regulations or just filing erroneous forms to get it done. I think that it's typically honest mistakes that need to be corrected.
Okay, thank you. Second question. We're nearing 50 employees, but I'm not 100% sure that we'll get there in 2018, but it's possible. Should we start tracking just in case, or do we need to wait until we hit 50 employees?
That's a great question, and I think the key here is that your applicable large employer status is determined by your head count in the prior year. So if you don't have 50 employees in 2017, and you might have them in 2018, I think you're safe to wait until 2018 and see if you hit that mark, because you wouldn't need to comply or be determined to be an ALE until the 2019 compliance year. So by the time you reach that point in 2018, you can still determine, just like all other employers did in 2015, they decided, okay, we need to comply, we need to report. So they determined a look-back period, and they started looking at data that went back sometimes as far as even 15, 16, 18 months back, once they figured out what their look-back method was going to be, what that time frame was going to be. So I don't think it's necessary to start tracking now, unless you feel like you might hit that 50 mark in 2017, in which case then you'll need to be making those offers of benefits in 2018. But you really, even then, I guess now's the time, because you don't want to miss the mark and not offer coverage to someone January 1st that you might have needed to. But if you truly don't believe that you're going to have 50 employees until maybe 2018, you still do have time.
Okay, thank you, Christy. And it looks like we're about out of time. Christy, thank you for presenting for us today. And thanks again to everyone who joined us this afternoon. Be on the lookout for the recorded version and the PDF slide deck coming to you Monday. And please take a few minutes to answer our survey, which you should be receiving shortly. Enjoy the rest of your day.